All right, so today what we're going to get into is talking about federal budgets. Oh, I have to actually pick. There we go. Federal budgets. And we're going to obviously focus our attention on the US case, right? And this is not because the US case is in any way special or unique or anything like that. It's just the one that I'm most familiar with. I think I've told you guys that I previously worked for the Senate Budget Committee, so this is an area that I know a little bit about. Okay, it applies, like the insights that we're going to talk about today apply pretty much equally to all democratic settings, regardless of where you are, with some slight modification based on the governing rules that democracy or parliament or whatever finds themselves operating within. Okay, so to summarize the semester, we've kind of just said, hey, there's this realm of topics called public choice. And that's hey, what is, government going to do? Right? And then separate from that was this other field that we've been talking about called public finance. And that is all right, so given this, how do we pay for it? Right? And we've talked about a few different tax schemes and ways to go about doing this, but we've never really sort of bridged this gap here. How do we actually cross that line and get into what it is that we're gonna be doing, right? Because over here on the public choice side, you could think this is talking about expenditures, right? We're gonna spend money on whatever it is that we decide. And then on the public finance side is we're going to raise revenue. And so the idea would be how do we make, these two numbers here, how do we make those numbers actually equal? And that's sort of the field or what we're going to get into today. Okay, so in principle, we'd like to think, so we're going to think about, expenditures on the one hand and revenues on the other hand. Now, in principle, we'd like to think that these two numbers are equal, right? Because that means that we're running a balanced budget. We're not overtaxing our citizens. We're not undertaxing our citizens. We're raising the amount of money that we actually need in order to provide the goods and services that we have decided to do, whatever those may be. But we can think about sort of the opposite cases. So what if expenditures were less than revenues, right? What would that look like? Okay, so if expenditures were less than revenues, right, we would call this a surplus. Okay, and there's an obvious quip that says, hey, we never see this in the real world, so why bother even thinking about it? But let's actually be scholars and ask this question. What would it look like? Well, at first blush, what it would mean is that the government taxed its citizens, too many dollars relative to what the government was going to be spending. And so what this means in the US context is that money basically left the economy, right? It went away from consumers or people that would buy things. It went to Washington, D.C. and sat in the US Treasury for some period of time. And then it goes back to the taxpayers, presumably, in some form of a rebate or something. Now, this is different from your tax returns, okay? So that's a whole separate issue. This is saying, we can have a situation like most of us in the U.S. do, where we have a deficit in our government's operating, and everybody gets rebates. Okay, we can have that. That's perfectly fine. It's not perfectly fine, but it's in theory something that can happen. Okay, this is saying that the government actually did collect more money than it needed to operate or to finance its operations. Okay. And so the money would then, leave the taxpayers, right? It would leave your paycheck. It would go sit in the treasury, and then presumably it would go back to you in the form of a refund, not just a rebate, but a refund. This seems somewhat inefficient, right? Unless we're using the surpluses to like retire debts, then it kind of makes sense. But for the most part, that's not something that we tend to do. And it's not really, it might be inefficient in the sense that it'd be great if we didn't have that surplus and then you and I and the other taxpayers could go out and spend money, earlier in the year perhaps. But it's not like a terrible thing. It's just, not perfect, right? And economists, as you can tell, are always obsessed with perfection. What if instead of expenditures being less than revenues, what if we had expenditures greater than revenues? Right? Well, that would be a deficit. Okay? And so here, excuse me, in this scenario, things look actually like a lot more common. This is basically the state of the world today and throughout almost all of the history of democracies. There's very few exceptions where this isn't true. The US, it's been true for the last, I think, 50 years or something like that. It's very rare to find expenditures not greater than revenues. Okay, and so this seems kind of strange because what's weird about it would be one thing to say that democracies just promote deficit, right? That would be one answer to this question. But here's kind of like the puzzle. If you think about it, how many of you have ever read about any individual, congressperson or politician or anyone involved in the legislative process having some sort of financial difficulty? Right? And the answer to that is basically none, right? They all seem to be doing perfectly fine at balancing, their own checkbooks when they're at home. But somehow when they get into, the halls or the chambers of Congress, that problem becomes much more difficult. Okay. And the other thing is, if it was just difficult, like if the problem was if the problem with running a budget in Congress is that it's difficult, right? Well, then we should expect to see errors on like both sides, right? Where, some years there would be a deficit, some years surplus, right? But on average, balanced. Right? And so like if the problem was just hard, right? Because they are dealing with, billions or trillions of dollars, maybe it's just a hard problem to get all these things to like work out. But the thing is, we seem to be really biased towards this. So we can kind of say that the reason why Congress or democracies in general tend to run deficits, it's not because the problem is difficult, right? And maybe it's because it's a group, right? And groups can do, as we've seen in class, groups can do weird things. So like maybe the problem is that it's like just a group, right? Groups do strange things all the time, right? But at the same time, we know that like churches, the Boy Scouts, colleges, for the most part, right? Big businesses, etc., right? They all tend to run balanced budgets, right? All tend to, balance their budgets, right? So, is it because a group is making this decision that means that democracies tend to run deficits? And that kind of isn't true either. Okay, so this is kind of an interesting thing, and the guy who had this kind of insight is a guy named Richard Wagner. In his book, Democracy, Debt, and Deficits. I might have gotten the words mixed up, and I obviously misspelled this one, so forgive me. But it's a great book. I highly recommend it. Richard Wagner is a wonderfully intelligent human being, and just a really clear writer. He's not a great speaker, so read his work. Maybe don't like watch him speak. But anyway, okay. So The question that we might ask is like, what effect does this have? This being, deficits. Right? So that might be one question that public finance scholars might focus on is like, what effect does a deficit have on maybe the economy, maybe on people's behavior, all kinds of questions in there. We might also ask a question like, where does government get the money they need? Right? So if they're not raising enough money through taxes, where does that additional money, come from? And so broadly speaking, there are two ways to do it. One is through what we call inflation, right? And this is a process known as seigniorage. And the second one is they can issue debt. Okay, so Congress can just issue debt pretty easily. Now, let's focus on the inflation part first. So with inflation, the way that works is basically you print money, right? And I don't want to be glib about it or flippant or whatever, but basically you just print some money. Okay, and here's kind of the idea. Those of you that remember from perhaps principles of macro or maybe intermediate macro, you know this general identity, MV equals PY. Okay, and so if you have M increasing, so M is the money supply, and if M is going up and V is kind of like staying constant, then either the price level has to go up or GDP has to go up. If real GDP is staying the same, right? So if real GDP stays the same, then like the price level has to go up. And that's what we call inflation. So like this right here is the inflation that we're talking about. But here's kind of what happens, right? So as you print money and let's say, you keep it, for yourself. You don't just like double everyone's salary or whatever. You actually print money and then just like hang on to it yourself. Well, what you've done is you've devalued all of the currency, but kept all of the additional currency. Right? So even though there's more dollars in the economy, and each dollar is worth less than it used to be in terms of its purchasing power. You, as the federal government in this case, you have more of those less valuable dollars, and so you have more purchasing power than you used to. So in some sense, some people will view this as like taxing people who hold cash, right? You are basically robbing purchasing power from the people that have dollars and giving it to yourself. Okay, and so that's like one way to do this, to finance the operations of government. It's not a particularly great long-term strategy. It can lead to what economists call hyperinflation, and that's never really a good thing. Okay, the other example, the other way to do it is to issue debt. Okay, and this kind of like sounds relatively straightforward, but it's kind of a weird one to think about. So I'm just going to give you guys like a concrete example to kind of latch onto. So let's suppose that we have some town, right? So we just have a town, right? And they exist, okay? And they finance all of their operations through, let's say, a flat tax on income, and that they're currently balancing their budget, completely perfectly. Everything's fine. And so one year, they realize that there's like a river between them, and the town, next door. And so there's like another town. Okay. And, wouldn't it be great if there was like a bridge, between these two, right? So we have this, idea that I would like to get to you and you would like to get to me, right? And so how can we do this, right? So we've got to pay for a bridge, and I'm not going to bother even trying to draw a bridge because you can see my drawing skills are abysmal as it is, right? And so let's pretend that building the bridge requires, let's say, 1 year of double taxation, or doubling the tax. Right, so just 1 year requires everyone to double their taxes for 1 year, right? Towns, can't print money, so that option is out. Okay, so the town can do one of two things. They can either temporarily double everyone's taxes, or they can issue debt. Now, if they double everyone's taxes, everything's good. People don't, they would just double the tax, and that would be kind of the end of it. But here's kind of the thing. For the most part, people tend to vote against raising taxes on themselves, right? So in general, people don't like to pay more taxes. We generally say, like, no, I don't really want to pay more taxes, right? And this tends to even be true even when people know that the increased taxation is, like, quote unquote for the greater good, because nobody really likes paying taxes. Like, some of us view the paying of taxes as our, like, civic duty, but I'm willing to bet that even the people who share that mentality, if you offered them a reduction in their taxes, which is to say that society is going to ask less of you, they would vote for it. Okay, and so the other solution is they could instead issue debt. Right, so rather than raising taxes, they could issue debt. Okay, now this gets at sort of the fundamental tension between public choice and public finance. We can simultaneously decide to build this bridge, right? And we can also decide not to raise taxes, right? And that's totally fine, right? We can say, yes, government, you must build this bridge, but you must not raise taxes on us, which is a very strange thing, right? Because we're demanding, and we are at some level commanding government to spend more money, but we're not going to give them more money, to do it. Okay? And this is the tension between public choice and public finance. Okay, and so in a world where we say yes to building the bridge, but we say no to the taxes, then the only thing left is to issue debt. Okay, and so this becomes a big source of a problem. Okay, so what this means is that we offer people the option to purchase government debt. Okay, or in other words, what we're doing is we're offering to, we can say it this way: we will let you pay more in taxes today, voluntarily. Okay. And then in return, once you kind of retire, once you, the person, so let's say, this is the government, right? And we're going to put a hat and a monocle on them, right? And they're happy. And then we have, average person here who is also happy, right? What we do is we have sort of like this magical piece of paper, right? Typically called a Treasury Bond or something like that, right? And I'll shade it in just because otherwise it looks weird, right? And we basically say, like, hey, we're going to give that to you, right? And then you, the individual citizen, you send money because you have to buy that bond, okay? Or that treasury note, or whatever you want to call it, okay? And we're doing very simplistic stuff here. Now, later on, right? So, later, perhaps like next year, or even 10 years later, depending on what it is, right? You, as the individual citizen, well, now you're holding, your note that you bought, over here, okay? And then we've got sort of the government, right? And he's apparently lost his monocle, because I don't want to draw a monocle again, okay? And he loses his monocle, and you say, hey, I'm going to give you this, right? It is now time for me to give this back to you. And then they're going to give, money plus interest, hence the $2 signs there, okay? And so what this means is, yeah, you're going to pay more in taxes today in one sense of the word, but the people who buy these bonds, right, they're going to pay, less taxes later, right, when they retire that bond, right, is one kind of way to think about this. This is obviously, it's going to be in quotes, okay, but it's one way to kind of think about it. So what it does, it doesn't increase the total number of taxes, the total amount of taxes paid. It only shifts them from the future to today, and it decreases future tax revenues, in that sense. Okay. But now we kind of have a problem. Over the lifetime of the town's government, tax revenue, okay, so here's kind of the problem. Right? Over the lifetime of, the government, if you want to think of it this way, right? Expenditures have actually increased, right? Because we built the bridge. Okay, but here's the thing, revenues actually haven't. Right? Because all we did is we let some people, prepay their future taxes, today. Okay? And this is where you run into the problem of persistent, deficits or debts. Right? Because in order to retire that debt, you do have to raise taxes. You can't get around that. That's not how bills work. And so what this means is that the town will have enough, finances or money to pay for the bridge, today. But in the future, they're going to have to actually retire those debts. And so they'll have less revenue. And that's where a lot of problems come in. Okay, is eventually, so even with issuing debt, right? And let's say you even did it at 0%. So let's say someone was willing to even at 0% interest, right? Which no one would ever agree to, but let's pretend that they did. Even with issuing debt, even at 0% interest, you still will have to raise taxes in the future. Okay, the only difference is you don't have to do it all right now. Okay, and so we'll get into some more of the issues with that in the next video.